Hey, what's up, stock compounders? Brad here. So it is time for our weekly Q&A. So let's dive right in. Someone on LinkedIn, a connection of mine on LinkedIn, asked, what do you think of the current level of the Buffett Indicator? For those of you who don't know, the Buffett Indicator is equity of U.S. public companies divided by GDP, gross domestic product. And you know, it's higher than any other time except the tech bubble. And I'll put a graph of it in my thumbnail for this video. So it does seem high, but Buffett mentions that it's probably the single best indicator of whether valuations are cheap or expensive, where valuations are at in terms of U.S. public companies. So they appear to be high. But you know, as with any of these single metric indicators, you know, you've really got to take it within the scope of the big picture, the many moving pieces with things like this. So, you know, while it certainly does make me more cautious than usual because of how I think public companies are valued right now, it's important to remember that timing the market is a very dangerous game to play. So, you know, if you're looking at the stock market as generally overpriced right now, and you're thinking, well, I'll just wait until there's a market crash or a market correction so that I can buy in more cheaply, that tends to be more problematic than helpful for investors as a whole, because there's nothing saying the market can't remain elevated just a little bit longer than you can remain patient, right? So you might say, well, I'm going to wait for the next year to see if there's a crash, and then I'll buy in. Well, what if there's a crash in a year and a month or a year and a half? You've been sitting on the sidelines that whole time. I think the smarter way to do it is to go by the value of individual companies rather than trying to value the market as a whole, trying to play a macro bet, the macro timing game. And, you know, so you have your list of companies that you're watching, you have your buy zone, and you're waiting until the company, any one of those companies, get into your buy zone. I think that's generally a more practical, better way to play the timing game. So the Buffett indicator seems quite high, but I don't think I would allow that to dictate my investing behavior. You know, I've got my watch list. When a company falls below my buy price, that's when I'm getting in. And if I really feel like I need to do something and none of those companies are in my buy zone, you can always just dollar cost average into the market as a whole, okay, into an index fund, something like that. Because the longer I invest, the more I appreciate the temptation to just do something, okay? So it's important to have something that you can do rather than trying to hold all of your chips close to your chest and, you know, try to outwit this temptation to do something. That's part of why I'm testing the magic formula investing approach. It gives me something to do every 3 months when there's nothing compelling to do elsewhere, right? At least, you know, every 3 months I can say, okay, what 5 magic formula stocks do I want to buy right now? It's really important to have something to do, even if it's just something small with a small kind of corner of your portfolio. I'm realizing the value of that as I go along. Question 2, why do I run so many ads on my videos? So I've had a few comments. I just recently monetized my channel, and I've had a few comments where, you know, they're showing like 6 or 7 ads on a video that's maybe 15 or 20 minutes long. And yeah, that does seem a little bit excessive to me. But at the same time, you know, as a creator, I don't have control over that. I'm partnering with Google. You know, they make, I think they make 55% of the ad revenue, and I make the rest. And I trust them to know what works best and to not kind of overextend those ads to drive people away. You know, they have so much data over the years of, you know, where is that tipping point between, all right, we're going to show this many ads, and we're kind of maximizing our revenue in that way, versus this is one too many ads where we're actually losing viewers. Okay, so I'm just going to trust that Google knows what it's doing with that. I apologize if it feels like too many ads, but I encourage you, if it feels like too many ads, you know, get on the other side, make videos, become a YouTube creator. And I noticed when I flipped on monetization, I'm looking at ads differently, much differently. When ads come up on other channels that I watch, it's not as much of a nuisance anymore. I actually get curious about the ad. Like, oh, if this ad was playing on my channel, how would I feel about that? What kind of quality does this ad have? There was an ad that came up recently on my channel before one of my videos for this autonomous lawnmower, right? So, you know, people spend so much money. I mean, it's such a huge industry, lawn mowing, and someone's coming out with this lawnmower that you don't need to sit on. You kind of program it to know where the lawn is, and a couple times a week you send it out, it mows the lawn. And I thought it was a really interesting concept. It's much greener because I believe it's battery powered, and it was just an interesting idea. So I was like, oh wow, an ad that actually pulled me in. Like, I didn't skip it. I was like, I watched a couple minutes of it. So, you know, to those of you who are annoyed by the ads in my videos, I do apologize for that. But you know, I've worked very hard to get to this point where I can be earning a little bit of money from my YouTube channel, and so I just encourage you to kind of take a different perspective on it. You know, sit in the seat of the YouTube creators for a moment. Okay, realize how much value, how much time they put into these videos, and that, well, you know, maybe it's not a huge sacrifice to spend 5 seconds a handful of times watching a video for them to make a little bit of income. So that's all I'll say on that one. Question 3, what's my take on Bitcoin and cryptocurrency? So I don't have much of a take on crypto. I do have some money in crypto. A couple of years ago, I put like $5,000 into a handful of different cryptocurrencies with the idea that, you know, I'm not going to look at this again for 10 years. Okay, I'm just going to put it in. I'm going to put it in the coffee can, for those of you who are familiar with the coffee can approach to investing. And I'm going to come back in 10 years. I'm just going to pretend, you know, it's not something that gets a new price every day. It's not something, I don't want to track it, okay? I think, you know, it's got a reasonable chance of being worth a lot more in 10 years. I know I don't want to miss the boat. It's something I want to be in, but I want to be in it with an amount that I don't mind losing, okay? That's the approach that I took a couple of years ago. And I think I got in Bitcoin around maybe $8,000 per Bitcoin. So it was after the huge run up, 20,000. It came back down. I don't know where it is now. I got in around 8,000, and we'll see where it is 8 years from now. It's kind of a set it and forget it thing. Question 4, Kevin O'Leary says you should always avoid non-dividend stocks as they are merely speculative. Is that true? So I take great issue with this statement by Kevin O'Leary. So when a company has excess earnings, there's really three things that it can do with those excess earnings. One is it can pay out a dividend to stockholders, return money to shareholders. The second is it can reinvest in the growth of the business. And the third is it can buy back its own stocks. It can retire shares of stock. And then each stockholder, each shareholder gets a larger and larger piece of the pie after those stock buybacks. So to me, out of those three options, generally dividends are my least favorite option. Because when a company pays out a dividend, the company is taxed on that dividend, and then the investor, when they receive that dividend, is also taxed on that money. So you've got this double taxation that eats away at the kind of long-term returns on an ownership stake in that company. And if I get dividends back, I'm just going to reinvest it into the company, because that's how you get compound interest. That's how you get compound growth, is by reinvesting gains back into the stock. So, if I have to pay tax on that and the company has to pay tax on that, it's eating away at that compound growth, and I don't like that. So, I think Kevin O'Leary thinks this way because, when he was young, his mom told him he should only invest in companies that pay dividends to investors. And look, guys, I'm sure there's a way to do very well if all you look at is dividend paying stocks. I just don't think it's the most intelligent initial filter to look at stocks through, to narrow down your list of stocks that you're interested in. So I don't know, maybe I'm missing something. If I am, let me know in the comments, but it just doesn't seem like intelligent advice to only look at dividend paying stocks. Question 5, any recommendations on YouTube channels for learning value investing for beginners? I do have recommendations. So Monish Pabrai, my primary investment mentor, has a YouTube channel, and he puts out 2 or 3 guest lectures a year where he does talks at business schools around the world. 2-hour talk, 2.5 hour, and they are incredible. There's just so much great information in those talks. In 2020, he's actually done a lot of kind of Q&A interview style talks on Zoom and put those out on his YouTube channel, and those have been fantastic as well. So highly recommend Monish Pabrai on YouTube. Another guy I follow, Aswath Damadran, known as the Dean of Business Valuation. He teaches business valuation at NYU, and he puts out a lot of videos on his YouTube channel valuing different companies, and he's very thorough in his valuations. And I think he's also very forthcoming about what biases he's bringing into his valuations. He's very self-aware in terms of his own biases, and I think that's really important because so much of business valuation, we bring our assumptions in when we value businesses, and the more we can identify those assumptions, the better we're going to do valuing companies and knowing kind of where the mistakes are, whether those might be skewed to the upside or skewed to the downside. Because really valuation, it's not an exact science. It's kind of a probability distribution of what a company might be worth. So the more you understand about the tails of those probability distributions, the the better we're going to do in terms of avoiding catastrophic mistakes. So those are two guys I really highly recommend for value investors. Question 6, how do you pick a winning company in an emerging industry? That's a great question. And a very tough question. Back in the early 1900s, there were around 2,000 automobile companies, public companies that you could buy, that you could invest in. 2,000 automobile companies. Now, it was obvious to a lot of people that the automobile industry was going to be a rapidly growing industry, right? So you might think to yourself, well, I need to invest in this industry because look at all of the growth. And that was true. There was a ton of growth in the automobile industry. But out of those 2,000 some auto companies, only 3 survived, okay? So even though, a lot of these smart investors identified this industry as one that was going to be growing massively, the vast majority of them lost all of their money in investing in auto companies. And, that's a really important lesson because, there's emerging industries right now. Electric vehicle industry is a very kind of new emerging industry with kind of Tesla taking the lead. And there's a lot of buzz around the electric vehicle industry. Same with, voice technology. We all know that we're going to be talking to our phones much more in the future and our other devices, right? Because it's a pain to have to use your fingers on your device when you could do it hands-free just by talking to it. So it's obvious that is going to be a growing industry, voice technology. But there's a big difference between being able to identify that an industry is going to be rapidly growing and being able to pick the companies that are actually going to benefit from that growth trend. So be very careful about not thinking that those are the same thing, because they are very different things. So personally, I don't try to pick winning companies in an emerging industry. I wait until I have more clarity about which company is going to be the winner. And am I going to leave some money on the table doing that? Potentially. I think much more likely is that I'll avoid losing all of my money by doing that. Okay? So, it's easy to come from the perspective of, hey, I'm going to miss out if I don't get in early on these companies. But, I encourage you to take a different perspective, which is, hey, I might miss out on all of the gains of the big winner in this industry, but at least I'll save myself from the pain of picking the losers and going to zero on those investments. So I think that's a really important thing to keep in mind. It's okay to give up some of the gains on these big winners so you can have a better chance of actually being able to identify who the winners are. Okay. And then last question, what is your favorite thing about investing? Oh man, well, it's really hard, guys. It's really hard. And it's hard on many levels. There's like the analytical level where, trying to predict what's going to happen with a business, within the whole ecosystem of competition and trends and, human behavior and human desires. There's so much psychology behind it, not just from, the growing a business end, but like investor psychology. And there's so much that works against us as humans to make rational decisions in the game of investing. It's just a fascinatingly complex game. And there's just no end to the learning. And it's very difficult to do well. It's very difficult to do better than the market. It's difficult to do better than what you could do by just investing in the S&P 500 on a regular basis, just kind of setting it and forgetting it. It's difficult to do better than that. And I think that challenge is exciting to me. It's also it's a little bit stressful at times, knowing that I can do well passively, and that putting all of this energy in may actually leave me in a place that falls short of what I could do just doing it passively. That's causes me a little bit of anxiety at night, but obviously because I'm doing it, there's more excitement than there is anxiety. But I have a healthy respect for people who just do it passively and make sure that they're going to finish, right? Rather than trying to be smarter than the majority of other investors by doing it actively. So that's my favorite thing about investing, the challenge of trying to beat the market and finish ahead of what I could do passively. So that's what I'll say about that. And that is the 7 questions I will tackle today in the Q&A. If you have one you want me to tackle next weekend, please let me know in the comments. And if you disagree with any of these, if you agree, let me know about that as well. It helps me to get feedback from you guys to know, whether I'm, answering questions that are interesting to you, or whether I should take the questions in a bit of a different direction next week. So any feedback helps. With that, I will see you guys in the next video. Take care.